When we talk about the leading bank in technology and digital banking in Thailand, KBANK immediately comes to mind, the green giant, right?
That's the one. They're definitely seen as setting the pace for digital transformation, not just in Thailand, but, across the region.
But digital leadership doesn't make you immune to the economy, does it?
Not at all. That's the reality.
Especially now. The global economy is still, volatile. Exports are struggling, and that household debt problem, it's still soaring here.
A tough environment.
So that brings us to a couple of core questions for this deep dive. First, did KBank actually maintain good asset quality in its Q3 2025 results, given all those headwinds?
A crucial question, yeah.
And second, maybe more long-term, is this big push into a beyond banking strategy, all the investment in AI, is that really going to drive clear profit growth down the line? Or is it, just expensive window dressing?
And that is precisely our mission today. We're going to dig into the Q3 financial results, look at what the market consensus is saying, IAA, InnovestX, and crucially tie it back to that broader economic context, especially the sobering long-term forecasts from places like K Research.
Right.
We're basically looking at a bank walking a tightrope here. On one hand, managing these really intense immediate credit risks.
Yeah.
And on the other, betting its entire future on a pretty radical digital transformation.
Okay, let's dive in. Hello, and welcome to Insight AI Briefs at Thai. Before listening, please remember to like, share, and subscribe. All right, so let's start where the market did. The headline numbers for Q3 2025 sounded like quite an outperformance, caught people by surprise.
It definitely did. The raw numbers were strong. KBank reported a Q3 net profit of 13,007 million Thai baht.
13 billion baht. Okay, solid quarter.
It is, but the key thing was the momentum. That number, it represents a 4.16% increase compared to Q2, so quarter-on-quarter growth.
Right.
And it's also up 3% compared to the same quarter last year, year over year.
Okay, so positive movement both ways. That sequential growth, the 4%, that feels pretty significant in what seems like a tough quarter.
Exactly. It signals their internal momentum is, quite strong.
You mentioned a surprise factor, though. 4% is solid, but what made this a real headline grabber? How far off were the analysts' predictions?
The magnitude of the beat. That's what really astonished people. If you look at, say, InnovestX's projections, KBank beat their estimate by a full 12%.
12%. Okay, that's
It gets better. When you look at the broader market consensus, the average expectation across all the analysts covering them, KBank surpassed those estimates by an impressive 17%.
17%? Wow. Okay, that's not just a rounding error then.
Not at all. This was basically confirmation that the bank's own internal models, or maybe their execution, was just significantly better than what the market was anticipating.
So a 17% beat.
Yeah.
That suggests something went really well. Something fundamental must have exceeded those cautious assumptions everyone had about the economy. What were the specific drivers? What delivered that outperformance?
It looks like it was fueled by a successful pivot, moving away from just relying on traditional lending income. Two main things stand out. First, they generated much stronger than expected non-net interest income, non-NII.
Right, so fees, wealth management, trading, that sort of thing.
Exactly. Fee income, wealth management results, trading gains. It indicates that their strategy to diversify revenue streams is actually working.
Okay, that's one. What was the second?
The second, and this really speaks to their management discipline, operating expenses were notably lower than many analysts had predicted.
Cost control.
Yes. They're clearly leveraging those digital investments they've been making to get real productivity gains, and that just drops straight to the bottom line.
So a double whammy, really.
Yeah.
Unexpected income strength and exceptional cost control. Okay.
Precisely.
So if we zoom out a bit from just Q3,
Yeah.
look at the year so far, January to September 2025. How does this strong quarter fit into the bigger picture for the first 9 months?
Well, the Q3 strength definitely gave the 9-month numbers a necessary boost. The total net profit for the first 9 months of 2025 reached 39,287 million THB.
Okay. And how does that compare to last year?
It's up, but only modestly, a 1.16% increase compared to the same period in 2024.
Only about 1%. So the picture gets a bit more complex when you look longer term.
It does. If you peel back the layers, the operating profit, before they account for expected credit loss or ECL and taxes, That actually went down.
Oh, okay. How much?
It decreased by 2.80% for the 9 months, coming in at 85,127 million THB.
Hold on, that's a really critical distinction, isn't it? If the profit from their actual core operations, before setting aside money for potential bad loans, if that went down.
How did the final net profit for the 9 months still manage to creep up slightly?
That's where the management of the provisioning buffer comes in. It's all about how they handle potential loan losses.
Right.
The overall net profit for the 9 months got a cushion because KBANK actually set aside less money for loan loss provisions in the first half of 2025. Compared to 2024.
Exactly, compared to the significantly higher provisions they made during the same 9-month period back in 2024. Now, they did increase provisioning again in Q3. That was a necessary proactive step we definitely need to talk more about.
Okay.
But those lower charges earlier in the year helped the overall 9-month comparison stay just slightly positive, even though the raw operational revenue was under pressure.
So it really highlights how much the final reported profit number depends on their assessment of credit risk and how much they decide to provision.
Absolutely. It's a key lever they manage very actively.
Okay, let's unpack that constant battle then. Generating revenue versus managing risk. Given everything we know about the economy, global headwinds, domestic debt asset quality has got to be the #1 fear for anyone investing in a Thai bank right now.
It really is the central point, yes.
So how is KBANK addressing these challenges? What's the current state of their credit risk?
This is truly the hinge point for the whole investment case. You're absolutely right. The macroeconomic environment is, well, intensely hostile right now.
Hostile seems like the right word.
Even the CEO was quite direct in her comments, really emphasizing the slowing Thai economy. We're seeing pressure from sort of 3 main directions that are stressing borrowers.
Okay, what are those pressures? Which external and internal factors are hitting KBANK's loan book the hardest?
Well, externally, the slowdown's hitting exports hard. We're talking decreased demand, and that's tied directly to global stuff like ongoing U.S. import tariffs and just general economic weakness in major trading partner countries.
Right, the global picture is murky.
And then internally, the really severe issue is that high household debt. It acts like a massive anchor.
Holding everything back.
Pretty much.
Yeah.
It limits private consumption, hits consumer confidence, which obviously impacts whether retail borrowers can pay back their loans. And it also stops the economy from generating strong new private investment.
So it's all connected, stress everywhere.
Exactly. This interconnected stress means borrowers across the board, from small retail customers right up to medium-sized businesses, the SMEs, they're all facing intense cash flow pressure.
Okay, in that kind of environment, the non-performing loan ratio, the NPL ratio, that's the ultimate risk gauge, isn't it?
It is.
So where does KBANK's gross NPL ratio sit right now as of the end of Q3?
The gross NPL ratio stood at 3.19% as of September 30, 2025.
3.19%. How should we interpret that number? Is that good, bad, stable?
Well, it needs context. Is 3.19% a sign they're managing things well? Or is it worryingly high for a major bank in such a debt-heavy market?
What's the bank saying?
Management is clearly signaling caution. They acknowledge the ratio needs to be watched very closely because of all this economic uncertainty. Honestly, just holding it steady around that 3.2% mark is probably a huge operational achievement given the pressures we just talked about.
So stable but under pressure.
Yes, but it signals constant pressure. It means they have to be incredibly vigilant, actively managing loans that are struggling to stop them from tipping over into actual default.
Right. And managing risk isn't just about the current NPL number. It's about being prepared, right? We saw provisioning was key to their 9-month profit number. Are they still playing defense, still setting aside a lot for expected credit losses, or are they easing up?
No, they are definitely maintaining a highly defensive, very prudent posture. KBANK continued that cautious approach, specifically with the expected credit loss, the ECL.
How much did they set aside in Q3?
In Q3 alone, they put aside a significant 10,179 million THB in provisions.
10 billion bad, just in one quarter.
Yes. And crucially, this was actually an increase of 1.29% compared to Q2, quarter over quarter.
So they're not pulling back, they're actually increasing the buffer.
Exactly. They are proactively building up their protective wall against potential future losses. This consistent, deliberate increase suggests management doesn't see the economic volatility easing up anytime soon.
If anything, they're bracing for more potential trouble.
It looks that way. They're positioning themselves for potential future spikes in defaults by creating these robust buffers right now.
Okay, that 10 billion bad buffer sounds massive. How does that translate into their overall safety net, their ability to absorb a really big unexpected shock? What's the coverage ratio telling us?
The coverage ratio. That's the metric that really shows their resilience.
Okay.
The ratio, that's their loan loss allowance compared to their total bad loans. It increased further. It reached 166.43% as of the end of Q3.
166%. Can you put that into perspective for us? What does that actually mean?
Sure. For every 100 baht of loans they currently classify as non-performing, as bad debt, they have already proactively set aside 166 baht in reserves to cover potential losses from those loans.
Wow. So they've over-provisioned, essentially.
You could say that. It's a formidable safety net. It's way above the regulatory minimums and provides a massive buffer, both financially and, psychologically.
And what about their overall capital strength? Basel III.
Still very strong. Their Basel III capital adequacy ratio remains robust at 21.60%. So fundamentally, they are well capitalized. And this provisioning strategy just confirms they're facing that asset quality risk head on with adequate defensive measures in place. #tags IV, revenue drivers, and operational efficiency. Okay, so now that we've established the bank is, financially robust, well protected against risk, we need to look at how they're actually making money in this really constrained environment.
Right. Where are the profits coming from?
This requires looking at the shifts, the dynamics between traditional banking income and the non-traditional stuff.
Okay, so traditional banking is all about net interest income, NII, the bread and butter, making money on the lending spread.
That's right.
But all that economic caution you described, the slowing growth,
Yeah.
that must be putting a squeeze on NII, right? Was traditional lending the growth engine this quarter?
Far from it, actually. This quarter really highlights the fundamental pressure on that traditional lending model.
How so?
Q3 NII came in at 34,158 million THB. That was actually down 1.43% compared to Q2.
Down quarter on quarter. Ouch.
And if you look over the full 9 months, the net interest margin, the NIM, dropped to 3.31%.
3.31%. That sounds like quite a compression in their core profit engine.
It is significant, yeah.
Why is the NIM shrinking like that? Is it just that they can't find enough good borrowers? Or is there a strategic reason?
It's probably a mix, but there's definitely a strong element of conscious strategy here. Slow loan growth is certainly a factor, yes.
Okay.
But KBANK has also proactively lowered some of its loan interest rates.
Really? Why would they do that if margins are already squeezed?
It seems to be a measured decision to try and ease the financial burden on their existing customers, especially those struggling with high household debt, to give them a bit more financial flexibility.
So it's a trade-off. They sacrifice some margin now.
Exactly. They accept some NIM compression in the short term, hoping to maintain customer loyalty and, critically, prevent otherwise good loans from turning into NPLs down the road.
So prioritizing stability and relationships over maximizing the immediate lending spread.
That seems to be the strategy. Yeah.
Okay, so if traditional lending revenue, NII, is actually shrinking, that puts enormous pressure on the other side of the income statement, right?
Absolutely.
This must mean that the non-interest income, the non-NII, was the real hero that delivered that big 17% profit beat we talked about earlier.
Exactly right. Non-NII was the key growth engine this quarter. Net operating income overall increased by 1.33% to 49,246 million THB.
Okay.
And that growth was overwhelmingly driven by their success in diversifying into these non-lending income streams. It's actually proof, maybe early proof, that their beyond banking ambition is starting to generate real revenue.
Okay, let's break down that non-NII growth then. Where specifically were they finding these new, presumably higher margin revenue streams?
The strength in non-NII came from mainly two big categories.
Okay.
The first is net fees and service income. And specifically, growth there was driven by fund management services.
Wealth management.
Yes. This points directly to KBANK, leveraging its digital platforms, likely offering a hyper-personalized wealth management advice, maybe investment products, probably through their digital channels.
Tailoring things to customer needs in this volatile market.
Precisely. By matching specific investment products to what customers need right now, they generate reliable fee revenue that isn't directly tied to loan balances.
Smart. Okay, that's fees and fund management. What was the second source of non-NEI strength?
The second key source was increased net gains from financial instruments measured at fair value through profit or loss, FVTPL.
Okay, FVTPL, that's a bit of jargon. For the average investor listening, what exactly does that mean? What are these gains?
Right. So FVTPL relates to a part of the bank's investment portfolio. Think things like corporate bonds they hold, government securities, maybe foreign currency derivatives.
Stuff they trade or invest in.
Exactly. It's the portion of that portfolio that they have to market, meaning they constantly revalue it based on current market prices. And any changes in that value, up or down, hit their income statement immediately.
Okay, got it. So strong gains here means...
It means two things. First, the market conditions must have been favorable, allowing the value of those instruments to go up.
Right.
But second, and maybe more importantly, it means the bank executed some astute trading and investment strategies. They actively capitalized on those market movements to lock in profits.
So it suggests they have a pretty competent treasury management team.
Very much so. Capable of generating significant returns on the bank's capital base, providing another income stream that's quite separate from the ups and downs of the domestic lending market.
Okay, interesting. Now, moving from revenue generation to the cost side. You mentioned earlier that operating expenses were lower than expected, helping the profit beat. What's the story on their productivity and cost management?
The story there is one of, well, relentless efficiency, it seems. Operating expenses only increased marginally, just 0.78% quarter over quarter.
Almost flat then.
Pretty much. And that minimal increase is actually even more impressive when you consider they apparently incurred some additional costs related to a special employee project during Q3.
A special employee project. Any idea what that might have been? The sources don't specify.
No specifics given, but in the context of a digital leader like KBANK, you can make some educated guesses.
Like what?
An expense like that is rarely just, standard overhead. It most likely covers things like maybe early retirement programs to help streamline their branch network.
Makes sense.
Or perhaps large-scale digital upskilling and training programs for their staff, getting them ready for this whole beyond banking model.
Investing in the future structure.
Exactly, investing in their long-term digital operating structure. Yet even with that extra spending, they still managed to keep overall costs tightly controlled.
And what did that do to their efficiency ratio?
That focused discipline resulted in a significantly improved cost-to-income ratio. It dropped down to 42.57% in Q3.
Down from what?
Down from 42.81% in Q2.
Okay, moving in the right direction. That cost-to-income improvement, that's really the hallmark of a successful digital transformation, isn't it?
It absolutely is. When a bank can generate more revenue, especially non-lending revenue, while keeping its cost growth minimal, it essentially demonstrates that those big digital investments are actually paying off in real efficiency gains.
Reinforcing the whole business model.
Precisely. #TAG-V strategy, analyst consensus, and future growth context.
Right. This brings us nicely to the future outlook. We've established Q3 was strong, efficiently managed. But the stock market, well, it's always looking ahead, isn't it?
Always.
So what do the experts think about the long-term potential here? Especially given KBANK's huge strategic bet on beyond banking and AI. What's the current analyst consensus on KBANK?
Well, perhaps unsurprisingly, given the Q3 beat and their clear leadership in digital, the analyst community is overwhelmingly bullish right now.
Bullish?
The latest IAA consensus, which surveyed, I think, 16 different brokerage houses, it shows incredibly strong positive sentiment.
Defined incredibly strong for us. How positive are we talking?
We are talking 93.3% bullish rating among those polled.
Wow, over 93%.
Yeah. 8 brokers recommended buy, another 6 recommended hold. That leaves basically no pessimistic voices in the room, at least in that survey.
So a lot of belief in the management and the strategy.
Intense belief, yes,
Yeah.
in the management team and their strategic direction. Now, if you look at the price targets, the overall average target price from these institutions comes out at 175.47 TIBOT.
175.47. Okay. What's the range?
The highest target price submitted was 192.000 THB, while the lowest was a 150.000 THB.
Okay, that's a pretty wide range, but the average is around 175.5. Now, this is critical context.
Yeah.
Where is the stock price actually trading right now compared to that target?
Right. As of October 21st, 2025, so pretty recently the stock price was trading slightly above that consensus average. It was at 176.50 THB.
So it's already reflecting that optimism.
Exactly. It tells you 2 important things. First, the market has already aggressively priced in that Q3 success and the positive digital story.
No kidding.
And second, anyone buying in at this price point is essentially betting on KBANK executing flawlessly and hitting somewhere near that higher end of the target range, maybe towards that 192 BART mark.
So it's priced like a premium asset already, based on expected future execution?
That's a good way to put it, yes.
And it seems like that confidence isn't just among analysts. There was news about GULF, the big energy company, increasing its stake.
Yes, that's another key piece of sort of external validation. GULF increased its holding in KBANK to 5.03%.
Over the 5% threshold.
Significant.
It is. When a large, sophisticated corporate investor like GULF, which understands the regional economy and finance landscape, when they commit capital to that degree, it's a powerful vote of confidence.
What does it signal, do you think?
It suggests they're endorsing KBank's strategy, that 3+1 strategy they talk about, and particularly its long-term digital pivot. They likely see sustainable value and stable returns coming down the pipeline. Okay, let's talk more about that strategy then. KBank is really, as you said, betting the farm on being the digital leader, investing heavily in AI for things like credit scoring, customer service, wealth management, all under this beyond banking umbrella. The sources confirm this commitment, but they don't seem to give us a specific ROI timeline for the AI investments, right?
No, those granular details aren't provided here. We know the strategy exists, the investment is happening, but not the exact expected payback period.
Okay, so we need to connect this grand digital ambition to the, frankly, terrifying economic reality they might be facing. What does K Research say about the broader Thai banking sector, the environment KBank has to operate in and maybe try to escape?
This is really where the conversation has to shift, from KBank's internal strengths to the external systemic risks. And yeah, the K Research forecast is truly sobering.
Sobering how?
K Research is forecasting that the entire Thai banking system's loan growth is heading for a severe slowdown in the next few years.
A slowdown, or worse. How dire is this systemic pressure supposed to be?
They're actually predicting a historical event. K Research forecasts that system-wide loan growth is expected to contract to shrink by 1.8% in 2027.
Contract the whole system by almost 2%.
Yes, that would be the first contraction for the entire Thai banking system since way back in 2010.
Wow, that's stark. What about after 2027? Does it bounce back?
Not really, according to this forecast. Even in 2028, they're predicting an abysmal growth rate of only 0.6%.
0.6%. That's barely moving. That's not just stagnation. It's like the core market is fundamentally shrinking or just treading water.
Pretty much, yeah.
So if the whole market contracts, even if KBank just maintains its current market share, its core lending business revenue would shrink dramatically, wouldn't it?
It would have to, mathematically, yes.
Why is K Research so pessimistic about the next few years? What's driving that bleak forecast?
It really boils down to these persistent structural problems that, digital transformation by itself can't just instantly fix.
Like the household debt.
Exactly. It's the dual challenge. A limited recovery in household income combined with that existing crushing debt burden. It severely restricts the ability of consumers and small businesses to take on any new loans.
They just don't have the capacity.
Right. And this constraint is expected to hit the retail segment consumer loans the hardest, which is usually where a lot of future bank growth comes from. K Research actually expects that specific segment to contract.
Okay, if I'm an investor holding KBank stock right now, I see the 93% bullish analyst consensus, I see the high coverage ratio. That makes me feel good. But then I hear this K Research forecast about a potential 2027 market contraction, and I'm frankly terrified. How do I reconcile those two massive conflicting forces? Are the analysts just ignoring this systemic risk?
I don't think they're ignoring it. I think they're essentially betting that KBank's digital strategy provides the only viable escape route from that systemic drag.
So the strategy is the differentiator.
That's the bet. The implication for KBank is profound. Their future success becomes entirely dependent on their ability to leverage that digital transformation leadership to do two things at once.
Okay, what are the two things?
First, they have to aggressively capture market share from their smaller, less digitally advanced competitors just to try and offset the overall market shrinking. They need to be the ones still lending efficiently when others can't.
Taking a bigger slice of a smaller pie.
Exactly. And second, and this is the really crucial point, they must fundamentally diversify their revenue away from traditional lending.
So the success of beyond banking, the AI, the digital platforms, it's not just about getting ahead anymore. It's actually about survival in a shrinking market.
Absolutely. That's the core tension, the bullish analyst sentiment you see. It's essentially a bet only on the success of that digital diversification strategy.
They have to make non-NIR work.
They have to rely heavily on non-NNI growth. The fees from wealth management, the trading gains, maybe new digital service revenues to offset this incredibly challenging low-growth lending environment that's forecasted for the entire sector.
And the AI plays into that how? We don't have the ROI numbers, but how does it help?
We can infer they're likely using AI not just for, simple chatbots, but for sophisticated, real-time credit scoring to accurately pick out the few really high-quality borrowers left in this debt-ridden market.
Finding the needles in the haystack.
Right. And also using AI for that hyper-personalized wealth management we talked about to boost those non-NII fees. Those fees become absolutely vital if they want to decouple their growth from the system-wide slowdown.
So if the digital investments don't deliver that fundamental revenue shift,
Then the contraction forecast will eventually hit KBANK just as hard as everyone else, regardless of how good their tech looks today.
Okay, so let's try and wrap this up. We've gone through a lot of detail on Q3 2025. What does this highly detailed analysis mean for you, the investor, looking at KBANK today? Let's summarize the fundamentals and that core tension we just discussed.
Okay. Fundamentally, KBANK delivered an excellent Q3 performance, no doubt about it, beating expectations by that impressive 17%.
Driven by internal factors, mostly.
Yes, driven largely by internal discipline. We saw efficiency gains, clearly shown by that drop in the cost-to-income ratio, and successful revenue diversification through really robust non-NII growth, which starts to prove the concept of their digital pivot is working.
So they're succeeding despite the pressure on their core lending business.
Exactly. They're managing to grow profit even as NII faces headwinds.
Okay. And the big shadow hanging over everything, asset quality, how do we summarize that? Managed defensively, but still the main risk.
Correct. Asset quality risk is definitely the shadow. It's reflected in that still elevated gross NPL ratio of 3.19%. But importantly, management is handling this risk with extreme caution. They're continuously building up that expected credit loss buffer.
Yeah, and the coverage ratio.
That huge 166.43% coverage ratio confirms they are robustly covered against potential immediate losses. They have a strong safety net.
And the analysts remain positive?
Yes, the consensus remains strongly bullish, reflecting belief in their management strength and digital strategy. But we have to reiterate, the current market price is already sitting at the high end of that analyst target range. The good news is largely priced in.
Right, so it sounds like KBANK is an extremely well-managed bank. They're doing pretty much everything right internally.
It appears so, yes.
But they're swimming against this massive, historically significant economic current that K Research is forecasting.
That is the ultimate balancing act they face. They have the capital, they have the digital tools, they have the strategy, but the market they operate in might be contracting.
Which brings us to the final thought.
Exactly. Which brings us to the final provocative thought for you, the listener, to consider as you digest all these results. The broader economic forecast, particularly from K Research, suggests this historically low growth environment for the entire Thai banking sector's traditional loan portfolio in 2027 and 2028, potentially shrinking by nearly 2%.
Tough backdrop.
Extremely tough. So since KBANK is positioning itself as the technology leader and it's already trading at a premium price that reflects this status, the critical long-term question isn't just about how well they manage today's NPLs. That's important, but maybe not the most important question for the future.
What is then?
The real question is whether their massive investment in beyond banking and AI can truly generate enough non-lending revenue growth, those fees, those trading profits, new digital services, to fundamentally and irrevocably decouple their growth path from the systemic slowdown in traditional credit growth that's forecasted for the whole sector.
Can they escape the gravity of the overall market?
That's the multi-billion-dollar question. If those digital investments don't fundamentally change the revenue mix, then even the green giant, as well managed as it is, will eventually struggle when the traditional lending pond starts to dry up. #TagTagZebin. Outro.
How was our in-depth look at KBANK? We certainly covered a lot of ground there. We hope this information helps you decide whether this green giant stock is right for your portfolio, and crucially, whether you believe their digital lead can truly outrun the macroeconomic gravity facing the entire Thai banking sector.
A lot to think about.
Definitely. If you have any questions about this, or perhaps would like us to analyze a specific stock in a future deep dive, please do let us know. We always appreciate your feedback. Finally, don't forget to like, share, and subscribe to support our team here. Thank you for tuning in.